Welcome to the MEBISODE Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
What's up, everybody? It's time for another MEBISODE. Today's topic is one that's gnawing at me for years, and I've never been able to complete this piece. Out of thousands of articles I've written, numerous books, white papers, blogs, all that stuff, this is one I've rewritten probably more than anything, and I don't think it's the best piece ever, but it may be one of the most important. And the topic for so many people is about what do they do with an investment once they have it? When to sell is the name of this MEBISODE, and it tackles when to let something go. Let's begin. You spent countless hours doing due diligence, digging through prospectuses, listening to podcasts, reading some white papers. You crafted a plan, implemented a sound asset allocation portfolio, reflecting your goals and beliefs. You put the money to work, and now you're invested. Many investors now think they're done. But for how much ever work went into the purchase decision, now comes the more challenging part. Many investors spend countless hours fretting, deciding on what investments to buy with their hard-earned money, their life savings, and then they just wing it. The phraseology we often hear from new clients is, "Hey, Meb, we bought your fund. We're going to watch it, and we'll see how it does. We'll see how it goes." What does that even mean? Translation: if the fund goes up and outperforms in the coming months, we'll keep it. But if it goes down or underperforms, you're out. And by the way, the benchmark comparison is never established ahead of time. Rather, it becomes whatever is performing well, which for, as we know, the past 15 years has been the U.S. stock market like the S&P 500. Is this the wisest strategy? Is it most likely to help an investor reach their goals? Is it most likely to help a financial advisor serve and retain their clients? I think there's a better way, which has resulted in this piece, this episode, this MEBISODE, this guidebook you're currently listening to. Think of it as an owner's manual, not just for our Cambria ETFs and funds, but for any of your investments. This guidebook will discuss how best to view your investments, measure their success, manage them within your portfolio, and recognize when it might be time to sell. So, given that most of us will not hold our investments until the grave, when might be a good time to sell an investment or a fund? We're going to break this down into three categories. 1, how long should you give an investment in the first place? 2, what are dumb reasons to sell? And 3, what are good reasons to sell? Number 1, how long to give an investment? All right, you built your ideal portfolio. Now what? History suggests that sometimes doing nothing is probably the wisest course of action. You let your portfolio just take care of itself. This is why when it comes to investing, we often like to say it's better to be Rip Van Winkle than Nostradamus, meaning it's better to go take a nap than try to predict the future. But sadly, most people have a woefully short time horizon when evaluating their results. When they hear Rip Van Winkle, the duration they think about or consider is maybe an afternoon nap versus a decade or two. Investors want their returns and outperformance, the certainty of making the right decision, and they want it now. As the late Charlie Munger said, it's waiting that helps you as an investor, and a lot of people just can't stand to wait. If you didn't get the deferred gratification gene, you've got to work very hard to overcome that. When we asked investors on Twitter how long they would give an underperforming investment, most said a few years at best. Contrast that with what podcast alum Professor Ken French said recently, where when we asked him the amount of time to confidently know that an active investor was generating alpha, he said, wait for it, 64 years. While French's 64 years is likely too long for you to wait to find out if your approach works, 3 years is also likely too short. Here's French in his own words. People are crazy when they try and draw inferences that they do from 3, 5, or even 10 years on an asset class or an actively managed fund. In this age of investment confetti and TikTok investors, the key is to zoom out and expand your investment horizon. But if you deem 10 years to be an unreasonably long period to judge an investment, just be aware that the shorter you hold, the more the randomness and luck will influence your returns. Returning to your investing plan, here's an example incorporating some humility pertaining to when to evaluate to help your future self. Maybe say, I plan on holding this investment for a minimum of 10 years. Anything less than that is likely too small of a period to make any rational or educated conclusions about the performance. When markets are hitting the fan, this statement will provide some much-needed balance and perspective. Suppose you buy a new fund and the strategy has a terrible first year. The pain of regret seeps in. And you say, I knew it. I knew I should have waited to buy that fund. I'm such an idiot. I should probably sell it now before it goes down anymore. You can then pull out your investing plan, find your zen, and remind yourself that 1 year is a lot of noise. So first things first, plan to give your investment plenty of years to perform or not perform before you pass judgment. So what are some dumb reasons to sell? While most investors aren't waiting long enough before evaluating their funds, they're also guilty of another cardinal sin of investing, and that's focusing purely on recent returns when evaluating. While this might not seem much of a sin at first, tell me this. When looking at performance over just a handful of recent years, how will you really know whether you're holding a long-term winner or loser? You see, even if you've correctly found a winning investment or engineered a winning portfolio, the winners also lose much of the time. In the midst of a painful, potentially prolonged drawdown, how will you determine if your losing fund isn't actually set to make you a significant amount of money in the years ahead? Vanguard wrote a paper called Keys to Improving the Odds of Active Management Success, and the authors examined 552 active funds that beat the market from 2000 to 2014. 94% of those funds underperform in at least 5 years, which is about a third of the time, and about half underperformed in at least 7 years, or about half the time. So even if you pick one of the winners, it will probably underperform in about half of all years. And that's a coin flip. And if you know anything about coin flips, you recognize that heads could easily show up multiple times in a row, meaning you could have a winning fund that underperforms a benchmark multiple years in a row. How many people are going to be willing to sit through that? Even the greatest investor of all time, Uncle Warren Buffett, has underperformed the S&P in about a third of all years, including multiple years in a row. Perhaps the best example of a winning investment appearing as a loser is Amazon. We've all seen the studies illustrating if you just put a few bucks in Amazon back in 2000, it'd be worth $1 gazillion today. But the reality is that just about no active investor would have been able to hold that long, and that's because Amazon suffered a handful of gut-wrenching 50% drawdowns over the years, one of which was a 90% plus collapse. Remember Amazon.bomb? There's a graphic from Bessenbinder, podcast alum, that illustrates some of the big drawdowns, and we'll put it in the show notes. If you're prone to fiddle with your portfolio and your main way of evaluation is performance, would you have had the foresight and discipline to stick with Amazon during this bloodbath? The reality is that even great stocks and or funds can go through long periods of horrendous market performance and yet still succeed. It's important to consider selling criteria ahead of time for the investments that perform poorly, though making such a conclusion requires sufficient time, as we pointed out earlier, but also for your investments that perform well. We often joke that investors have told us, hey, Meb, I bought your fund, it underperformed the benchmark by more than it should, so I'm going to sell it. You're an idiot. Thanks a lot. You know what I've never heard once? Hey, Meb, I bought your fund and it outperformed the benchmark by more than it should, so I'm selling it. No, of course they don't say that. Theoretically, both should be disqualifiers, but in only one scenario do people sell. In the other scenario, people tell me I'm brilliant. Thank you, Meb, for sending my child to college. I love you, on, and then they buy more, which is not the way it should be. Many investors become emotionally attached to investments that perform well and extrapolate that performance into the indefinite future. This is usually a very bad idea. The late, great John Bogle would track the top 20 investment funds per decade that outperformed, then track those outperformers into the following decade. In every decade, the high flyers crashed back to earth and became big losers and underperformers in the ensuing decade. We'll put a chart in the show notes, but as Bogle once counseled, don't just do something, stand there. Clearly, we want to avoid the high flyers that crash back to earth, and let's be clear, professionals are not that much better at this than retail. We all love to look down our nose at this crazy Reddit retail, but the pros are often just as bad. Academic literature backs this up. Goyle and Wayhall wrote a paper examining 8,775 hiring and firing decisions, 3,417 plan sponsors delegating $627 billion in assets. What'd they find? Professional managers chase performance, and on average, they would have been better off staying with the old manager they fired instead of the shiny new one they hired. So if all that you're evaluating is recent returns, watch out. So what's the wise way to evaluate your investing portfolio? So if performance alone, and specifically too short of a window of performance, isn't a good way to evaluate a fund, what is? Here's a few potential ways to evaluate and consider selling your fund. Here's one. The assets of an existing fund strategy are becoming too large to implement effectively within a fund structure. We profiled one over the last few years that won Fund of the Year and then consistently was buying up 20% of the float of stocks and has underperformed by not just percentage points, but I think multiples of 10, 20 percentage points. Sometimes size is an enemy of performance. Often it is. Number two, your goals have changed. So let's say maybe you got a new grandkid or some unexpected health concerns. 3, the thesis for why you invested in the first place didn't play out. 4, the fund manager retires. Maybe you got a discretionary manager or the strategy experiences style drift. So if your S&P fund turns into a Bitcoin fund, there's legal or structural tax changes that have made the strategy less effective. Our shareholder yield book talked about this with the entirety of the dividend world, which currently ignores share issuance and stock buybacks, which to me is crazy. A new strategy offers superior diversification to your current portfolio lineup. So example would be, hey, I got to buy a whole portfolio. I'm going to sell some US stocks and buy foreign, or I'm going to sell some and buy real assets, or I'm going to buy trend following, on and on. Or lastly, here's another one. Your fund may increase its expense ratio or all in fees, or there's just cheaper, more tax efficient choices readily available. If you're still stuck in a bunch of 1.5% tax inefficient mutual funds, it could be a good excuse to move to low cost tax efficient ETFs. All these are justifiable criteria to evaluate a fund, as well as examples of valid reasons to sell. Make sure you include this as part of your written plan. And as you write down your reasons for evaluating and selling an investment, try and be honest with yourself. Richard Feynman once said, the first principle is you must not fool yourself, and you're the easiest person to fool. The key question is, are you chasing performance or implementing a valid sell decision? A fun little use case is say, hey, I'm going to write out in my investing plan, these are the reasons I can sell a fund, and don't include performance as any of them, and see how that changes your methodology. So what advice do we offer investors during tough times? And that's to be your own best friend. On our podcast, we often ask guests, what was your most memorable investment? And often the answer is very painful, something that went south or a big winner that evaporated. Us old traders have had enough losers and bad decisions to fill volumes of trading journals. One of my favorite investing quotes is from Bill Duhamel, is every trade makes you richer or wiser, never both. Considering this reality, we'd like to conclude this short MEBISODE with an important note on the entire process, and that's be kind to yourself. If you're paralyzed by, should I sell it, should I not sell it decision, our favorite algorithm, very sophisticated, is go halvesies. In other words, sell or buy half a position rather than a full position. By doing this, you diversify your possible outcomes, which helps avoid regret, which is a significant emotional burden. The halvesies approach can manifest itself in different ways. If you can't decide which fund to buy out of two, buy both, but with smaller position sizes. If you can't decide whether to sell your position, begin selling smaller portions of positions spread equally across 12 months. Or if you want to buy something but are nervous about the lofty valuation, begin purchasing a small lot today and be prepared to expand your holdings over time. Again, try to write down the process and rationale beforehand, not after. Let's just see how it goes. In short, stop viewing your investing decisions as binary black or white. You can dip your toe in and out of the water. Just don't use this concept to deviate too far from your process. So anyway, effectively navigating the market's ups and downs, as well as the inevitable underperformance of your specific investments, can be incredibly challenging. But with deliberate thought, foresight, and planning, you can overcome those challenges with a balanced portfolio that helps you reach your financial goals and, as importantly, enables you to avoid sleepless nights filled with, what should I do? questions. This brief episode aims to help you consider key issues impact your portfolio performance, wealth, overall confidence as you engage with the markets. Thank you, and good investing.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.